Okay, can you hear me just to make sure before we get going? Excellent. Super good. Okay, well, welcome to this webinar hosted by FX Street. Today we are going to talk about currency strength and supply and demand and how the two can be combined. So currency strength is something that I've been looking at for a very long time. I think we could go back as far as maybe 2010 when I started looking at it. And so this is something that I wanted to incorporate with something else. That something else happened to be supply and demand. And so very, very briefly on myself, most of you know who I am, but I'll just run over this quickly. I work with IT security and have been doing so for a very long time. And who needs more security than anyone else seems to be the banks. And so I normally do security assessments for banks, typically trading software, hedging software, API software, stuff like that. And via my work over the past 16 years, I got to know a lot of traders. And most of the traders were, of course, institutional traders. And so I had the opportunity to ask them a lot of really interesting questions. And I mean, 15 years is a very long time. And I mean, back before 2010, I didn't really know what trading was. I had no interest in it. And so the things that they were telling me back then tended to repeat themselves an awful lot. It's not until after 2010 I started to apply them in the form of programming software and trading myself. But the key concepts that I kept hearing over and over again were supply and demand and strength. And they would refer to a currency as having relative strength in comparison to another currency. For example, if one currency is strong, then it's stronger in relation to another currency, but it might be weaker in relation to another currency despite the strength. So it's a very interesting concept and one that I've really studied in depth here for a very long time. Okay, so let's keep moving on. These key concepts that I kept hearing about were, of course, the supply and demand. And so they would often talk about supply and demand, and then I would interrogate these traders as I got to know them over lunch, and they would refer to supply and demand as limit orders. And I didn't really understand what it was when they would refer to it as limit orders. And then they would, of course, refer to it as liquidity, and this started to make a little bit more sense. But ultimately, supply and demand is the struggle between the buying and the selling. And so this is something that is very clear on a price chart if you know what to look for. But you can also see it in relation to the strength, relative currency strength between two currencies. It's a very interesting concept. So if we have a quick look here, you can see that we have a marketplace here. This is, for example, level 2 order book stuff that we can see here. This is very fictitious and inaccurate, but I'm just showing this for the sake of example. So here we have very small pockets of liquidity, and here we have very big pockets of liquidity relative to these ones up here. So if I ask the question, would selling or buying 50,000 move the market more? Well, you can see very clearly that if we were to buy 50,000, this 50,000 order would consume these first 5 layers, each containing 10,000, because in order to fill my order, I would have to consume this level, this level, this level, and this level. And so price would move up. So this relatively small order would in fact cause the market to move. And if I was filling this order, this 50,000 unit order, the function of price moving higher is ultimately slippage. We look to the downside, we have these much larger pools of liquidity, 200,000. And so if I was to sell, all the liquidity available at this area would simply consume my order, and the market would not move at all. So someone else would have to come with an order 3 times the size of mine and also sell for it to even move past the first pocket of liquidity and bring us back to the one just below here. So this could be, these pockets of liquidity could, as an example, be maybe 5 pips apart. Just to have a rough example of what we're looking at. So here, when I'm buying, I'd move it 5, 10, 15, 20. I'd move it 25 pips, and if I sold, it wouldn't move at all. Okay. So we consider supply and demand for a moment. We have big buying, we have limited selling. What does that do? Well, that means that we have a very clear imbalance in the buyers and the sellers. We have more demand than we do supply. So going back to this, we have more demand than we do supply. This is going to make price move higher through the thin liquidity. This is thin liquidity in relation to the order that enters the market. Then we have the opposite, and this is we have much sellers, much selling, and we have limited buyers. And so the sellers will be able to consume the buyers, and this is going to drive price low. And if we go back to this chart here, when you'd ultimately flip this around, put the thick liquidity to the top and the thin liquidity to the bottom, and then would be selling, and this of course would drive price lower. So it's pretty clear as to what's going on. Okay, so that's pure supply and demand. Okay, so how do we identify this supply and demand if we're not looking at a price chart? Is there a way to do this? Well, there is a pretty good way to do this, and it's a very powerful way as well. And these squiggly lines, they may mean nothing to you, but what they are representing is currency strength. This one up here, the green one, the lime green one, is a Swiss franc. We have the euro. We have the Japanese yen as the purple one. We have the brown, which is the Kiwi, the British pound, the American dollar, the Australian dollar, and the Canadian dollar. So this shows me that if I wanted to find the pair that was moving the most, then I'd want to pair the Swiss franc with the Canadian dollar. So I would sell the Canadian dollar Swiss franc, because this chart is telling me that the thinner liquidity is moving in a direction of is buying this currency pair. So we have demand for the Swiss franc and we have supply of the Canadian dollar. So if we look at this price chart here, you can see that this is wriggling higher pretty nicely, pretty efficiently. Prices moving sideways here. We have some small spurts higher, so we have an imbalance in supply and demand here. We have more buyers than we do sellers. Price rallies. We accumulate orders. Price feeds back into the demand. So price is seeking liquidity to fill these long orders, which it finds at roughly this area, which is the point of release, the origin of this price inefficiency. We find it. Price continues to wriggle higher. We move sideways for a long time. So this is a balance in supply and demand. All of a sudden, we have this fresh buying. So someone comes in the market and they start buying, and this pushes price higher. This could be speculation. It could also be a big organization simply doing business. It could be hedging. It could be absolutely anything. We don't really know what it is that caused price to move. So price rallies. Here it feeds back into this price inefficiency. So we're seeking the thin the thicker liquidity. So which is down here. Price comes above it, and we find some buyers, and then price continues to drift higher. And it continues to do so like this. So if we look on the currency strength, the relative currency strength between these two currencies, we have the euro here, and we have the British pound here. So you can see very clearly that from this point on here, which is this side of the chart, that the euro was attracting buyers, and people who had assets in the pound were liquidating these assets. Sorry, a bit of a tongue twister. Matter of fact, I'll just tell you, I'm having the windows in my home changed at the moment, and it's winter in Denmark. And so I have no windows in my home, and I'm standing here with woolen socks on and a woolen jumper. And I've got as many doors between me and the people changing the windows closed, but it's still freezing cold in here. So you might hear my teeth chatter now and again. Anyway, back to the presentation. So we have the euro, which is attracting flows, and we have people liquidating their British pound assets here. So this is causing this currency pair to move higher. Then we have this one here, which is a very typical range-bound market. Price is wriggling sideways, as you can see here. So price is going up, it's going down, it's going up, it's going down. So every time price is out of balance, which it is when it comes up here, price returns to parity, which is down here. Price leaves, we're out of balance, we rebalance this, and price returns to parity, and probably fills a price inefficiency further here to the left. price goes back because we leave this liquidity void in the wake of this move, rebalanced. Then we leave this one out, it's rebalanced, and we leave this one here, and this is rebalanced. So what does this look like if we look at currency strength? You can see for this pair, this is the Australian dollar, American dollar. And if you look at these, you can see on the left side here how we have the American dollar is kind of going up and down. In the same way, the Australian dollar is going up and down, kind of an opposite, almost like a mirror reflection of these two currencies. So this shows, this is very clear when you look at price. Price is going up and down, up and down. You look at the currency strength, price is doing the same thing. It's going up and down, up and down. This is a very clear representation of a sideways range-bound market when you look at currency strength. So it's very clear and easy to spot as well there. Then we have this one here. I mean, why is this price moving lower? You can see price is just really moving lower very, very steadily and relatively efficiently besides this here. So if you look at the strength of these two currencies, you can see that we have the Swiss franc and we have the Canadian dollar. And so we have a demand for the Swiss franc and we have supply of the Canadian dollar. And this, it's actually, the symbol is CAD franc. And so the cross currency is being bought, which is going to bring this currency pair down, as you can see here. And it's coming down pretty quickly as well. We're seeing a lot of red bars being painted here as price slowly drifts lower. Okay, Carlos is saying that is the present chart of the euro pound. No, it isn't. This presentation was made years ago, so this is a very old one. But we're going to have a look at the live charts in just a second. Okay, so you can see very clearly here. You can see here for a moment we had Canadian dollar strength, Swiss franc weakness. They crossed, went past the zero line, and then they started to verge, which we could see very clearly represented here in price. And so if we consider currency strength analysis for a second, this tells us which side of the market has the thinnest liquidity and which side has the thickest liquidity, because this is very interesting for us, because we ultimately, we want to put our targets in the direction of the thinnest liquidity, and we want to put our stops on the other side of these pools of liquidity, which we'll refer to as the thick liquidity. And if you have any questions about that, go and have a look at the previous presentations that we've done here at FX Street, and we elaborated that in great depth. And maybe go to maybe one of the first two ones, and I think you'll that'll help you out there. And so ultimately, price is going to move in a direction where supply and demand is either greater, dependent on the opposing areas of liquidity. So if we look at currency strength for a second, I mean, how can you calculate currency strength? Well, it's actually a pretty simple task, and I've made some like pseudo code here. So you iterate through the currencies that you're interested in, and for I mean, the software that I've written is focusing on the 8 most traded currencies, which are the ones that we saw on the graphic previously. Then it's iterating through all of the currency pairs here, and it's looking to see if currency is in the currency pair. If it is, it's going to perform a small calculation. If it isn't, it's going to move on to the next one. So this is a really simple way to do this, to iterate through the different currency pairs, extract the currency that we're looking for, do a quick calculation, save the value, go to the next currency pair. And it does this for all 28 currency pairs, and then it has actually calculated something that you could refer to as being very similar to a dollar index, but instead of being a dollar index, we have the dollar index, euro index, pound index, Japanese index, so on and so forth. So this gives us this chart that we referred to earlier on. And so here we have the Swiss franc, the euro, we have the Kiwi, which is brown. The reason the Kiwi is brown is because in New Zealand they have a lot of cows. Cows eat grass. Grass grows in soil. And then we have the euro, which is blue. The European flag is blue. Swiss franc is lime green. Don't know. That's probably one of the colors that was left over, as was magenta for the Canadian dollar here at the bottom. Then we have the American dollar here. So ideally, if you look at this, let me mark the text here, make it a bit smaller. So if you look at this, and it gives you a pretty good idea as to what you want to be doing. You want to be pairing the strong currencies with the weak currencies, where in this case you would be looking to pair the euro and the Swiss franc with the American dollar and Canadian dollar. So instead of looking at a price chart and saying, okay, I want to trade the euro US dollar because I like to trade the euro US dollar. While that can obviously have benefits, because if you focus on one currency pair, then you're going to understand the fundamentals, and also the fundamentals of that pair, what drive that pair, but also the price behavior of that pair. Going at it this way will really put the odds in your favor, because you'll be focusing on the real reason the price is going to move. So if you pair, for example, the Kiwi and the Japanese yen, then you're going to have a very tough time, because you're going to be forced to trade a market that isn't going anywhere. Similarly, if you trade the euro, Swiss franc, even though they're both strong, it's not going to be doing anything. It's going to be moving sideways because they're both strong. And so you want to pair a strong currency with a weak currency, and then you use supply and demand to refine your entry. We move on, we have a look at this. You can see this is the euro CAD. We have a look here. We have the euro, which is a strong one, and the CAD, which is the weak one. I mean, how's that for a nice move? These indicate days. I think this is an hourly chart. So these are 1 day of trading. You can see this pair is roaring north. And despite that fact, look how it respects these areas of supply and demand. Here we have a range-bound market. It breaks out, range-bound, it breaks out. This price imbalance originates from here. Price references it. We buy here. Price goes up. Have another range. Price goes up. Price imbalance. Where does it come back to? Demand. Price goes up. It doesn't come back at all. We have this area, this period of accumulation. Price rallies up and price comes to the upper edge of it. We have a look at this one here. A little bit different, but this is the euro American dollar. If we have a look here, you can see that we have the euro on the top and the American dollar, which is the second weakest on this chart. You can see this is doing pretty much the same thing. Very similar price patterns in these two pairs. And you can see we have this area of demand. Price retests it, it comes back. And so you can see very clearly by looking at strength information what you should be trading. And you use current supply and demand to position yourself in relation to where these unfilled limit orders are located in the market. And while this is not a great price imbalance, this is not a great area of demand, we are trading in relation to the valid and the current currency strength, which gives this area of demand much more clout. We have a look at this one here. You can see that this is the American dollar Swiss franc, which is moving lower. We have the American dollar, which is weak, Swiss franc, which is strong. So we have demand for the Swiss franc, supply of the American dollar. This is going to bring this currency pair lower, as you can see, and price is racing lower. So we broke out of this period of accumulation, this range-bound market, extended accumulation. Maybe on the daily chart, we have maybe 1, 2, 3, 4 accumulation candles, and then price breaks away and start to move lower. And the same applies. You could probably take this chart and you could overlay it on the chart above the euro US dollar, and they would probably look pretty similar. But this is just a really nice example of what you can get when you have a look at a currency strength. And so yes, so ultimately you look at the strength information to tell you what to trade, and you look at the supply and demand to find out where it is that you want to get in. So entry levels, as we mentioned, we have supply and demand. What else do we have? Well, we have psychological numbers. I don't pay too much attention to these except for the big figure. If we have a nice area of supply or demand that overlaps with a round number, well, then I'll certainly feel more comfortable taking that level. Additionally, if you use Fibonacci numbers, and you can do these as well, because if you have overlapping Fibonacci's, or you have areas of supply and demand that are located very, very deep in the curve, well, then this is also going to be this is going to give you more confidence to take the trade, which is ultimately what we need. If we have a look at some examples, these are very, very old charts. If we have a look here, these are psychological numbers, these blue lines here, and these ones here, these are areas of supply and demand. And instead of removing them because they've been disqualified, I left them on here so that we could see how price would react at them after they had been drawn on the chart. And you can see here we have, this is the British pound, American dollar. The British pound is red, the American dollar is green. And you can see that the American dollar is slowly drifting lower and the British pound is looking pretty flat, as you can see here. So if you look at this, you can see, well, the British pound is the cross, the British pound American dollar is moving higher. So shouldn't the British pound be stronger than the American dollar? Well, not. It doesn't have to be. It just has to be either the American dollar has to be weaker or the British pound has to be stronger for this pair to move higher. Matter of fact, I wrote a post on this on my website, pipnotic.com. I just type it in here so you can see the link. And I wrote an article there about this, and so have a look there. And then you should be able to find that post. It's a very, very interesting post, a very interesting study actually. Good. So this one is wriggling higher as a result of what you can see here. If we have a look here, you can see we have a very different picture. We have a very clear winner, the euro, and a very clear loser, which is the American dollar. Hence this very nice push higher. You can see that, the thicker line is long-term strength, the medium thickness is medium, and the short term is short term. And so we are seeing a lot of information on one chart here. We're seeing a lot of information. So you can see the overall trend for this pair is up. So you don't want to be selling this, even though we have some areas that might look attractive. So for example, let's see this one here. So you want to sell here. You don't want to do that. Why? Because the major flows are moving into the euro and out of the American dollar, which means that you do not want to be selling this. So keep this. If you keep your eye on the currency strength information, well, then you're definitely going to be mindful of what's going on the bigger time frames and with the major flows. And if you have a look here, this is the example we just looked at on the Australian dollar, American dollar. Well, this pair is just wriggling sideways, as you can see. And if you look here, you can see these lines just kind of braided together roughly around the zero level, which is the black line. So this pair is actually going nowhere, moving sideways here, and then it starts to go down. So wouldn't you expect this pair to go down? No, you wouldn't. As long as they're both moving down, then the currency pair itself is moving sideways because they're both weak, or they're both strong, or they're both neutral. So this is something that you want to pay attention to. You have to remember this is relative currency strength, not absolute currency strength. And here you can see how we have, this is pretty flat. And if you look overall, you can see that price is going down, rebalancing, out of balance, balance, leaving parity, returning to, leaving parity, returning to. And you can see this here. This currency strength reading does not resemble this one where we have a very clear imbalance between the two. And so this might encourage you to trade supply and demand as a range-bound market, so selling tops and buying bottoms, so selling at supply and buying at demand. You can see here at the very end we had a sudden increase in buying pressure on the American dollar and selling in the Canadian dollar. Actually, it was more as a result of the selling of the Canadian dollar, which brought price slightly higher from here. Okay, if we have a look at a couple more examples, you can see that this one here is, again, it's snuggling the zero line. Price is kind of moving sideways like so. Very clear example of that. And here we have the Swiss franc, which is moving higher, and we have the Australian dollar, which is moving lower. And so the strength of the Australian dollar is stronger than the Swiss franc, which is going to bring this pair lower. And again, this is a really nice example because you can see price selling. We're accumulating. So here we are building up pressure to do what? To move lower. What does that tell us? That tells us that we have people that are willing to sell this pair at this price. So you naturally want to put your limit orders at the bottoms of this range, your stops above, in anticipation then that this is going to continue. So you don't want to sell here, or you don't want to sell once price is moving away. You want to wait until price returns to parity, which it will always have to do on some time frame before it continues in the direction of the trend, which is for this pair to move lower. Got a couple more examples here. We have a look here. We have the Australian dollar, Japanese yen. The Japanese yen is the purple line. The Australian dollar is this one here. And you can see that this one is, I mean, it started up here. So we had a lot of strength on the yen, weakness on the Australian dollar, which brought it down. And then now you can see the shorter term strength readings starting to move towards the zero line, which is going to give us some sideways price action. So price comes up, we leave parity, we return to it. And while returning to while filling this liquidity void, we create a new liquidity void, which price returns to. That's balanced. We leave this one in our wake, which has to be balanced. When price left here, we created this vulnerable price exposure. Price comes pretty close to it, then it goes down. So price is moving down. What would naturally happen? Well, we'd expect price to come back up and rebalance prior to either moving lower or, depending on the sentiment, moving higher from there. Have a look at this last example. This is telling us not really to do anything. This is telling us to either trade it range bound or wait for something else to happen. And when you can see like this happening here, you can see a sudden increase in selling of the Australian dollar and the Japanese yen stays pretty neutral. Well, then you'd want to position yourself short for this currency pair here. And yes, the tail unfolds. Currency strength continues to push this currency pair lower. And yeah, that's just a pretty good example. We're gonna go to the charts now and have a quick look and see what this looks like on a price chart. And I've made here, you can see we have long-term strength, medium-term, and short-term. So this currency strength reading here, this is showing us currency strength in minutes over the past day. So this is what the currencies have been doing over the past day. And if you have a look, you can see that the pound has been bought very much so throughout the course of the past day. You can see the Kiwi has been sold off very much so. So if we take the pound, the Kiwi, where is she? There we are. This should be moving higher. If we go here, we go to maybe an hourly chart. Oops, wrong one. Let's go here. You can see that this is a wriggling high, which really shows us the same representation of this scenario just in price. And so you want to position yourself along. So what do? Well, then you have to buy at demand. So you can, we'll do that. We'll do it the easy way. You buy yourself at demand. So you want to position yourself to buy here, here, or here. Why here? Because here we had a major, a relatively major swing high. Price went down, price rallied, we accumulated, and then when price left this period of accumulation, we managed to move above these highs, telling us that we have a lot of demand at this level. So this is the area, the natural area that we would want to sell at, to buy at. So if we put it in here, you put your order to buy here, plus a pip or two to get in the spread, price comes down, tests, we go up, we have another test, and then this is the test that quenches the thirst of the buyers, and then we manage to continue to move higher. I see there's a comment there. Let me grab that quickly. Okay, Carlos is saying, I agree with all these tools to be used as enhancers when applying supply and demand. In addition, interpreting the open position ratios can be very helpful as well. They will all help to strengthen our contextual take on decision making. Absolutely, absolutely. I mean, currency strength, it's not something that you can use isolated. Supply and demand is, but currency strength isn't. It's just an extra tool to kind of bring your attention to what is actually going on in relation to these currencies. So it's a very good point. Very good point, Carlos. So here you can see that this pair is obviously moving higher, as you can see here. If we can see there's something going on here. We have the American dollar, which is selling off, and we have the British pound, which is picking up some, was attracting some buyers. So let's have a look at that. This is on the very small time frame. So we're going to go on the 1 minute chart, and the pound dollar should be beginning to wriggle higher. Let's have a look at that. Yes, you can see it's something's happened. There's maybe some news that's just come out. I haven't been paying attention today. As I mentioned, my windows are being replaced, so everything else is secondary. But you can see now the price. We had a test into price poked into a pool of liquidity. There's demand here. Tested it once, twice. Price gapped higher, and then we saw price move higher from there. So this is again a very good representation of what we can see here on the strength. We have the pound, which is the red, and we have the green, which is the American dollar. But you can do this on all time frames as well. You don't have to do that on one time frame alone. What I like to do is I like to look at, for example, if we look at a period open, let's say we want to see what's gone on in hours since the beginning of the week. So I go to the hourly chart, and now I can see, let's give it a second. Now I can see what's gone on with the 8 currencies since the beginning of the week. We're at Thursday. You can see that the euro has been the big winner this week, and we have the kiwi, which has been sold off. So if we clear this template here and we put the euro kiwi on, then we'll probably realize that this has attracted a lot of buying here. So you can see that price has been wriggling high. This is on the hourly chart, and this shows us a very clear picture of exactly that. Price is wriggling higher, which we can see here. We have demand for euro, and we have supply for the kiwi. So very interesting indeed. But if we want to do something maybe higher time frame, so we say we want to go to the beginning of the month, we want to look at 4-hour data, and I'll simply go to the 4-hour chart. Give it a second to load. It has doing a lot of number crunching. Glad I don't have to do this stuff manually anymore. And you can see we're seeing the same thing. So if we go to the 4-hour chart, you'll see the same thing going on. How price is. Let me move this down. How price is. I'm just going to take this off. How price has wriggled higher since the beginning of the month. You can see if we go to October on the 14th, so since about here. Actually, let's see where we are here. So they started to verge here. So this is on, what day is this? This is on the 9th of November. Let's find the 9th of November. Yeah, so right around here, we were being told that we should position ourselves long on this currency pair, just around here. So price started to wriggle higher from there. And you can see that nothing has changed yet. So ideally, you can hold this position a little bit longer, depending on what opposing supply and demand is doing. We're also testing these highs up here, so we have to be a little bit careful. This would ideally be a good place to square our order, maybe reduce risk or take some profit. But we haven't done our top-down analysis. This is just as an example. So you can see that we're testing some highs here. So this could be a nice area to take something off the table. But you can also do this on, for example, the smaller time frames. Do we have any? Yeah, and the euro Australian dollar. Let's have a look at the euro Australian dollar as well, Carlos. Yeah, the same thing here. We're on the daily chart. Let's go to the 4-hour, and you can see here. This is actually even more so, which is very clear. You can see this was the weakest currency, and it became the weakest currency on the 9th of September. Let's find the 9th of September here. Here, 9th of September. It happened just here. So right here is when this currency pair, rather the Australian dollar, was flagged as being the weakest currency. And you can see, it went parabolic. This almost looks like a Bitcoin chart. But it's really moved higher from there. And you can see, of course, this information very clearly here. But you can do this also on the shorter time frames. Back a few years ago when I quit my job to trade full time, I was trading on the 1-minute chart at the London Open. And I'll just show you what that looks like and what I was looking for, because you can use the same information for that. Go to the session open. So this is currency strength since the open of the session. And actually this is going to be We're probably pretty close to the American Open by the looks of it. And so if we go to the American dollar Kiwi, this pair should be moving lower. You can see it's starting to, this is on the 4-hour chart. We go to maybe the half-an-hour chart. You can see that, yes, we're wriggling lower pretty nicely. So what do you want to do? Well, you want to be selling at supply. Keep in mind, this is shorter-term trading. If you look at the big overall picture, the Kiwi is the weakest currency by far at the moment. So just be careful with that. But for illustrative purposes, I mean, this is just a very nice example. And you can see that the Kiwi became the strongest currency during the North American session at, as we do it precisely, at about 1524. If we go to the minute chart and look, 1524 here. So right about here. This is where the Kiwi started to be coined as or flagged as the strongest currency. And then we had a bit of a pullback, and then price started to wriggle higher from there. So really, really interesting, I think. I use it as an aid and as an overlay for supply and demand, but supply and demand is king. And this just helps me maybe do some shortcuts if I'm just scanning pairs quickly. But it's a super interesting utility, I think, currency strength. Does anyone here use currency strength at all? Or do we have pure price action people in the room? Hey, James, good to see you in here. Okay, Carlos does. There are some technical components as well. The high frequency trading levels of demand, monthly and 3 months. The Aussie, the Kiwi, we're approaching, we're a factor in the chart. Yes, absolutely. Definitely. We've got a lot of people hopping in here. Okay, good. Yeah, it's an amazing addition, I think, to what you're doing. As a matter of fact, I programmed a robot that traded currency strength. If you want to read, let me find a link and you can read about that. It's a very interesting. Let me get that for you. And I made an automated trading robot that would trade currency strength. And it was a very difficult beast to harness because it's a very complicated topic because there are so many parameters. Let me see. Okay, so if you go here, you can see there'll be some articles and you can have a look at the ones there. And there are some, where is it? Yeah, you'll see some of the robot stuff in there under that category, or automated trading. Let's see. Okay, here it is. It's algorithmic trading, not currency strength. Let me put it in. This one here. Here you'll be able to see. Yeah, trading is very, very complicated. It's simple, but it's difficult to do. I mean, the algo trading that I was doing on currency strength was really interesting, but often when the signal came in, the move had already happened. And so then you had to stomach a drawdown in order for price to continue to work for you. And so it was a bit of a frustrating approach. Then I went to supply and demand, where I did the pure supply and demand trading robot, and that was actually very interesting. It's still in the works, and it's exciting. As a matter of fact, I think it was the last presentation we did here at FX Street that covered this robot project. It was very interesting. So check that one out if you're interested in that. But a very interesting indeed. Good stuff. Any questions before we wrap things up? Hi, Abdul. Good to see you in here again. Excellent. We've covered pretty extensively a lot of theory on supply and demand in the previous material, and we'll continue to do in the future. And we'll touch on currency strength as well now and again. It's a very interesting topic, but we'll always combine it with supply and demand. No, I don't trade CFDs. I stick mostly to currencies at the spot market. But I mean, my software can be used on anything, and so as a result of that, I'm looking like stock. Some of the other MT4 brokers are beginning to increase the number of symbols that they offer. No futures either, unfortunately, but it's certainly an area I'd like to get into. It's I'm a bit of colorblind in that regard. I've always focused on currencies due to my my security work, but and so I don't really know a whole lot about them. I think if I was to trade, rather if I was tasked with security testing a futures trading platform or binary options trading platform, then I would probably be trading that today. But I didn't. I was initially introduced to currencies, and I think it's a fascinating topic as well, currency strength, and also currency strength. Then you can write some pretty amazing tools when things get pretty relative, of course, as they do here with currencies. So it's a super interesting topic. What about you? Are you into futures? Are you CFDs, Carlos? All right. Okay. Okay. Super. Of course, the FX futures, definitely. Excellent. Any more questions before we wrap things up? If you want any more information, you're welcome to write to me. I'll just put my email in here. There you are. But we do mostly, currency strength, supply and demand. Our primary focus is supply and demand. Currency strength is it's also exciting to look at. So if you're looking for a bit of entertaining, then you can put on a currency strength indicator. Then you got to. It's like going to Tivoli. You can't trade CFDs in the US. I see. Okay. Excellent. Good stuff. Sounds good. All right. Well, hey, it's a great pleasure. Hans, thanks so much for being here. I'll be back again next month. If there are any topics that you want me to cover next time, you could shoot me an email at the email I provided there, and I'd love to touch on those during the next session next month. Okay. Good. So thanks, Carlos. Thanks, Hans. Thanks, everyone, so much. Have a lovely weekend when you get there, and I'll catch you all soon.